All right, welcome to The Explainer. Today, we're going to break down the strategy known as advanced smart money concepts. We're going to move past just looking at confusing squiggles on a chart and actually learn to read the story the market is trying to tell us. So here's the game plan. We'll start with the absolute basics, the language of the market. Then we'll learn how to spot those critical turning points. After that, we'll dig into the market's secret fuel source, figure out how to map our key zones, and finally, we'll wrap it all up into a simple but really powerful framework. Okay, let's dive right in. Look, before we can do any of the advanced stuff, we've got to nail the fundamentals. And in trading, it doesn't get more fundamental than understanding market structure. Think of market structure as the skeleton of any price chart. It's really just the sequence of peaks and valleys, the highs and the lows, that tells you what the market's overall direction is. Are we climbing a mountain or are we sliding into a valley? Market structure gives you that answer, clear as day. And this really shows you the two main states we're interested in. You've got a bullish market, which is making higher highs and higher lows, kind of like walking up a staircase. And then you've got a bearish market, which is doing the opposite, making lower highs and lower lows. For now, let's just focus on these two trending states. Okay, so we can see the staircase. Great. But now we need to know how to spot the signals that tell us if we're going to keep climbing or if we're about to turn around. This is where two really critical acronyms come into play. Let's break these down. You've got BOSS and you've got SHOTCH. A break of structure, or BOSS, is basically the market giving you a thumbs up, confirming the trend you're already in is still going strong. But a change of character, or SHOTCH, well, that's a warning shot. It's the first real sign that the party might be over and the trend is about to reverse. A BOSS is super straightforward. In an uptrend, the price makes a high, it pulls back a bit, and then, boom, it breaks above that previous high. That break right there, that's your BOSS. It's the market just confirming, yep, we're still headed up. A CHOCH, though, is where things get really interesting. It's a signal that something might be changing. Notice here how the market was in a nice uptrend, but instead of making a new high, it broke below the last higher low. You see that? It just violated the uptrend pattern for the first time, and that is our first major clue that the whole dynamic is shifting. All right, this is where we peel back another layer and get to the real engine behind this whole strategy. We're moving beyond just looking at patterns, and we're going to start to understand the fuel that actually makes the market move. So let me ask you this, and be honest. Have you ever seen what looks like a perfect change of character? So you jump into a trade expecting a big reversal, only to watch the price whip right back around, stop you out, and then continue in the original direction. It feels like the market just played you, right? Well, that gotcha moment isn't random. It's not a bug, it's a feature of the market. It's a move that's specifically designed to trap traders. It tricks them into thinking a reversal is happening, and once they've put their money on the line, their orders become the fuel, or what we call liquidity, that the big players use to shove the market in the direction they wanted to go all along. This trap has a name. It's called inducement, or IDM. It's that first really tempting pullback that looks just like a change of character. Classic retail traders see it and they jump right in. But in smart money concepts, we learn to recognize it for what it is, bait. It's put there to lure people in too early, and learning to spot this is the key that unlocks this entire strategy. But here's the trick. To spot the real inducement, you first have to know how to identify a valid pullback. Just look at the examples in the green circles. In every single one, a candle's low breaks the low of the candle that came right before it. That little move is called sweeping the liquidity. Now, look over at the red circles. See how none of those candles break the low of the one before it? Those are invalid pullbacks. That's just market noise, not a true structural point. Okay, so now that we're in on the market's little secret of inducement and liquidity, we can start using that knowledge to our advantage. It's time to start mapping out the specific zones on our chart where we might actually want to take a trade. We call these zones points of interest, or POIs, and I really want you to focus on that word zone. We're not looking for some magic single price line. Nope. We are identifying areas where, based on everything we know about structure and liquidity, we expect the market to have a big reaction. These are our high probability hunting grounds. Now, there are a bunch of different POIs, but let's focus on two of the most powerful ones. First is the order block. This is usually the last down candle right before a massive move up, or the last up candle before a big drop. It's like finding a footprint left by an institution. The second is order flow, which is just the big directional move that happens after that block. You put them together, and you've got an incredibly powerful zone to watch.
So think of this as your mental checklist, your core concepts: break of structure, change of character, liquidity, inducement, and your order block. These are not separate ideas. They're all interconnected pieces of the same machine that drives the market.
Whew, okay, we have covered a ton of theory, so let's bring it all home. Let's synthesize everything we've talked about into a simple, actionable framework that you can start using to look at charts today. At the end of the day, this whole strategy can really be boiled down to these 4 steps. 1. You do your homework on a higher time frame chart to find your major POI. 2, and this is the hardest part for most people, you do nothing. You wait patiently for the price to come to you. 3, when it finally gets to your zone, you drop down to a lower time frame and look for a confirmation signal, like a CHOCH. And finally, 4, only then do you act. And this right here, this is the golden rule that ties it all together. If you only remember one thing from all of this, make it this. Market structure is the map. It shows you a likely path. But liquidity, that pool of orders sitting above highs and below lows, that's the treasure. That's where the price is ultimately being drawn. So the next time you open a chart, I want you to ask yourself this question. Are you just looking at lines and patterns? Or are you starting to see the deeper narrative? The story of how big players induce smaller players to create the fuel they need to move the market. Because once you start reading that story, everything changes.